Hi and welcome to the monthly outlook hosted by Centrum. The markets at around 25,000 level seems to have stabilized quite well over the last couple of weeks. And this is basically a culmination of three things, if I might say. One is good earnings season, Q4. Second one is a lot of geopolitical situations globally being taken care of, a lot of fear being, allied over there. And the third is a lot of domestic issues being getting a hold on, right? Now, if you look at the domestic issues, the third point, if we take it first, then the macro data has been coming in fairly decently well. Inflation has been at, I think, a 6-year low now since 2019 at below 4% levels. 4 to 6 is where the RBI tolerance band is. And this is a great situation to be in. Not just is the inflation low, but the rupee dollar movement has been favorable towards us. The crude has witnessed a very sharp decline in prices. That essentially means the outlook for inflation going forward also continues to remain benign, especially given the fact that food inflation has been on a downward trajectory. This basically means that we should expect, at least if nothing else, 2 more rate cuts from RBI. This is going to be positive from three perspectives. Number one is it going to be helping the credit growth in the economy go back into the low to mid-teens levels, which have kind of settled down at the low to double-digit levels. Number one. Number two, it will give a boost to consumption, especially leverage consumption, discretionary consumption. So larger ticket size sectors like, for example, auto, like, for example, real estate, brown goods, white goods, they get a huge amount of boost overall thereof. And third is a ripple down effect. It has a cascading effect, the multiplier effect it has on the overall economy. So I would want to believe over here is that when you look at consumption, when you look at rural and urban consumption, discretionary consumption, when you look at credit growth, when you look at inflation, when you look at the overall macro situation from India's perspective, I think we have come a long way. And this is also being testified by the latest GDP numbers that came in at 7.2% levels, a marked improvement on a quarter-on-quarter basis. Now, as far as earnings growth season is concerned, Q2 of last year was definitely a bottom. Q3 was better than Q2. And Q4 has largely been in line with expectations, right? Now, this is a great thing. When you look at the macro improvements along with the Q4 numbers, then I think it paves the way for a very clear-cut double-digit earnings growth starting from Q1 onwards, right? Q1 FY26 onwards. Effectively meaning that you're looking at a 12% plus earnings growth coming through next financial year and the first quarter of FY26 on a bare minimum basis. For a market that's trading at around 21 times for large cap stocks, given about a 12% sort of earnings growth, I think we are very favorably poised with pockets of value still existing. For example, banks. They have a very large weight in the index, 35-37% or thereabouts. All of them are trading at historically low valuations, not really expecting anything much in terms of asset quality either. So a bottom case being built in as far as earnings growth, credit growth, asset quality, everything. I think that's a great place to be in. Like I said, real estate, auto can be another space where you can have. Pharma is another space which we are very bullish on. And the third and the final part as far as equities are concerned is the whole global geopolitical situation. Now, very thankfully, the whole tension that existed between India and Pakistan seemed to be well settled, which had spooked market for a little bit in between. Most people should have taken advantage of it. If you have not, then it's still not too late about that. But that's one part which is well settled. Now, as far as India and US, trade agreement is concerned and the tariff war is concerned, I know these skirmishes continue, the noises will continue intermittently in between, but I think we are much closer to a resolution today than what we have ever been before. The India-UK FTA is a testimony to that. We've been struggling for over 2 decades with that. Now that is almost done, and the Europe-India FTA is also closer to being signed. And given that IT and pharma are out of the purview of the India-US trade agreement, then I think we are anyways relatively much better off as compared to the rest of the world. So I think given that we are looking at about 12 to 14% earnings growth for the next couple of years, we are looking at 15-16% ROE from a large cap space perspective, we are looking at stable 20-21% times valuations. I think this is a great time to invest in equities if you're looking at a base case scenario of multiples staying where they are, but market still delivering on the back of earnings growth. You'll still have about 12 to 14% compounded earnings growth from the market, even from these levels. So I think look for a bottom-up approach, look for large cap buyers, look at larger sectors, relevant sectors like BFSI, and you have a winning portfolio over here. Happy investing.